kicking off the second quarter in the red after a record first 3 months of the year. But since 1950, April has actually been the best month of the year for the blue chips, posting about a 3% increase. So, will the record rally roll on? Here now, CNBC's Seema Modi, still on the set with us. Jim LeCamp is Senior Vice President of Investments at UBS, and Lee Munson, Chief Investment Officer of Portfolio, LLC, and author of Rigged Money. Wow, that sounds frightening. Lee, tell me, what do you think? This rally that we've seen in the first 3 months of the year, are we going to see it for the rest of the year as well?
I don't think so, Michelle. I think that, we have on par right now 8 to 10% profit growth for the S&P 500. I think we've done it. Do I think the market could go higher the rest of the year? Yes. I think we need to take a 5, 7, maybe 10% breather on the downside. And then I think that we're going to be ready for some new highs, maybe a Santa Claus rally, maybe by September, October.
We're looking at the Dow at 14,572. Where does it end the year, do you think?
On the Dow, let me get my crystal ball here. I say that it'll be about 15,001, but most importantly, I like the S&P. I think the S&P could hit close to 1,600. I'm not, I'm no Columbus on that one.
Okay, Jim, what are you expecting after this very strong start to the year? Which historically, when you have a strong start, it actually portends well for the rest of the year.
It does, and I would point out also the last 7 Aprils we've been up. So April's been a very good month of the year. Now, beyond April is usually when the market hits a correction. It has for the last 3 years. But last year's correction was only 5.5%. Michelle, stocks right now are benefiting from a strange combination. We've got global money flows coming into U.S. assets. That's why, uncharacteristically, stocks are rallying alongside bonds and the dollar. Secondly, the momentum play is in stocks right now. So all the momentum chasers, the performance chasers are in stock. So you have this dual combination of a flight to safety from globally, and domestically you've got the momentum play in stocks. So yes, I think this market could go higher. We have this big thundercloud out there, and that is possible bank runs in Europe, and I think this is being discounted too quickly. But beyond that, as long as the market continues to set higher highs and higher lows, we're going to be playing this market.
Seema, what are you hearing from market participants in terms of whether or not they think this can keep on going?
I think there's two things. One is learning about where we could potentially see the market move higher. We've already seen the defensive sectors like consumer staples and healthcare move higher. They've had strong moves over the past 3 months.
Which is a little bit strange if you're expecting a strong economy, right?
Exactly. We have a lot of theorists out there who say that these two sectors could continue to move higher, even though a lot of these stocks are trading at a premium to the S&P 500. And then there's other sectors like tech, which I follow closely at the NASDAQ, that are still trailing the S&P 500. The big question is, when is tech going to join in on the rally? And I think when we start seeing sectors like that outperform, there are a lot of traders who say that's when we have a true U.S. market rally.
So, Lee, what are you doing in the meantime with your money at this point?
Well, first of all, we want to be neutral weighted. So if we sort of have a classic 60-40 mix, we don't want to be overweight this very second. What I'm waiting for is for maybe a little earnings announcement. Jim was talking about some sort of storm in Europe.
For the novice viewer, a 60-40 mix is 60% in stocks and 40% in bonds?
Exactly. Our typical client at our firm Portfolio, that's sort of like your general moderate risk portfolio. A lot of retired people, a lot of pensions will have that kind of 60-40 mix. So what we're trying to do right now in putting money to work, if the rest of the year goes great, we make money, no problem. But because stocks and bonds are doing so well right now, I think you got to wait for that 5-6% spring sale that we're expecting, and then you go overweight stock for a lot of the reasons that Jim was talking about. We love U.S. stocks. There's a lot of reasons for that. I am also sort of the contrarian and putting some money into emerging markets. Some think it's early. I just think that it is yet to participate in this global rally. How do you define that? Because they've
changed over the last couple of years. How do you define emerging markets these days?
Well, I would probably say I take South Korea out, but I'm looking for anything. I don't like stuff that's heavy in Russia, but I still think you can look at, mid to smaller caps in China, India, all through South America. So I think outside of taking South Korea out, I still think it's, mostly those BRIC countries. You can buy ETFs that follow it pretty easy. Just make them smaller caps versus the big
Jim, what do you think?
oligarchs.
What would you do right now if you were giving specific advice on sectors or ETFs to people?
Well, I don't agree with Lee on the one thing. On the emerging markets, we're not there yet. I traditionally have loved emerging markets. I don't see it in the charts. I think he's way too early. And if there's a problem in Europe, it's going to hit any big risk asset, and that will be viewed as that. Where do we put money now? We're seeing big moves of medical-related fields. Biotechs, we're really hot on that sector. Things that move things from the oil patch, the rails, etc. Things that participate in the fracking industry, like the silicas and things like that. So there's plenty of plays out there. I do agree with Lee, though. You got to be a little careful. We've raised a little cash, and we think there will be some 5, 6, 7% correction, and that's where you really want to step on the gas this year. I think you have to wait for that, though, because we've gone a long time without that correction.
I think that's an interesting point on the Dow Transports. That index is many times seen as a leading indicator for the market. It's been hitting new all-time highs over the past couple of months. Just recently, though, we've seen that index move lower. So is that a potential
a hint that maybe the economy is slowing?
Yeah. S&P could move lower in the near term.
The economy's not that good. The economy hadn't been growing that good. I mean, everybody says, oh, look, the U.S. economy's doing better. What was GDP? 0.4%. Economic reports have been coming in a little.
Come on, Jim. Jim, you know every economic indicator out there is good.
You were both arguing that basically the U.S. was the dog with the least fleas, right, in the world at this point?
Yeah, but not because our economy's doing so great.
I think the U.S. doesn't have fleas. I think that we have good stuff.
Guys, one at a time. Jim?
Yeah, the economy's not doing that great. It's doing better than Europe, and we're not playing the risky game that Japan is playing, and we're not lying as much about our data as China is, so the U.S. is the fatter cow in the slaughterhouse right now. We've got global money flows coming in here.
Got it.
That being said, we're not growing. We don't have a lot of momentum in the economy. We're growing, but we're just kind of stumbling along.
Lee, you get the last word here before we go.
Just remind everybody out there, when unemployment is high like it is now and inflation is low, the future expected return to the stock market does very well. So I say buy it when it looks garbagey like it does now.
All righty. Guys, thanks so much. Jim LeCamp, Lee Munson, Steve Mimodi, thanks so much.